So, right now, an opinion piece in a newspaper about a politician who explicitly isn't even running is somehow worth more than a direct endorsement from a former president.
I mean, yeah, it sounds crazy, but that is exactly where we are.
Welcome to the deep dive. We're looking at June 2026, and the 2028 presidential election isn't just a political contest anymore. It's basically mutated into this hyper-volatile financial market.
Right. It's a landscape where literally every debate gaffe, every leaked memo, and, every unexpected polling bump gets instantly converted into a price tag.
Yeah.
The traders operating in this space, they aren't sitting there thinking about who gets the most electoral votes 2 years from now. They are hunting for the candidates who will experience the sharpest shift in momentum over the next, 48 hours.
Exactly. So today, we're taking you into the engine room of that market. Our source material today is a really fascinating trading analysis from June 19, 2026. And it breaks down how active traders are using prediction markets, specifically looking at Polymarket via a platform called Predmart. And they're using it to turn tiny political ripples into just massive financial windfalls. So our mission here is to decode how the market prices political probability versus certainty.
And how adding leverage to that mix creates just absolute chaos.
Totally.
Because it requires a completely different framework than your traditional political analysis. You really have to strip away the emotion, the ideology, all the punditry, and just look strictly at the mechanics of risk, capital allocation, and, narrative momentum.
Right, which brings up a really important point. Before we jump into the mechanics of all that risk, a quick but mandatory note to you listening.
Yeah, this is important.
Our source touches on some really politically charged figures across the entire spectrum. We aren't taking any sides here, and we're definitely not endorsing any viewpoints.
Exactly.
We are strictly unpacking the market dynamics and the data exactly as they are presented in the source material. We're basically looking at the board through the cold, calculating eyes of a trader.
And the current state of that board is what makes this entire strategy even possible.
Yeah, lay it out for us.
Well, we are sitting here in June 2026, and the field is just completely fractured. The nominal frontrunner, J.D. Vance, holds an 18.4% probability. Then you have Gavin Newsom sitting at 16.1%, and Marco Rubio is at 15.6%.
Okay, let's unpack this because no single candidate commands even a fifth of the market's confidence.
Right, it's totally spread out.
And if you're new to how prediction markets function, just think of it like a futures market for real-world events. A contract pays out exactly $1 if the event happens and $0 if it doesn't.
Right.
So when J.D. Vance is trading at 18.4%, that just means his contract costs about 18 cents. The market is pricing him at an 18.4% chance of winning the whole thing.
Which, if we connect this to the bigger picture, inherently means the market is pricing in an 81.6% chance that the current frontrunner actually loses.
Right.
Because the market prices probability, not certainty. The vast majority of the board is just scattered between 2 and 10 cents.
And that fragmentation is where the real financial opportunity lies, right?
Exactly. Because a single viral interview, it doesn't need to make a candidate the undeniable nominee. It just needs to move their perceived probability from, say, 4 cents to 8 cents.
And if you're just buying contracts with cash, turning 4 cents into 8 cents is a nice little doubling of your money.
Yeah, not bad.
But traders aren't just using cash. The source analysis focuses heavily on the use of leverage.
This is where it gets crazy.
Yeah. If you've never traded on margin, think about it like buying a house. You don't usually pay the full $1 million in cash. You put down a small percentage, a down payment, and borrow the rest.
Right.
If that house's value goes up by just 10%, your actual equity, like the cash you actually put in, might have just doubled. You've leveraged a small price movement into a massive percentage gain on your capital.
And on these prediction platforms, traders are applying 3x or even 5x leverage to these political contracts. So a candidate's odds shifting from 5% to 10% might barely even register on a national news broadcast. But to a trader holding a 5x leveraged position, that modest little 5-point bump just turned into a staggering account game.
But the flip side of that is equally brutal, isn't it?
Oh, absolutely.
Because if you were leveraged 5x and the candidate drops just a few percentage points, your position is liquidated. You are entirely wiped out.
Yep, it's gone.
So if the upside on these low probabilities is massive, you'd think traders would just target the highest probability on the board. J.D. Vance at 18.4%. But the data shows the smart money has actually been betting against him.
Yeah, J.D. Vance provides this really fascinating case study in how markets separate a political narrative from the underlying data.
How so?
Well, as we noted, he's at 18.4%. But in early June, just a few weeks prior, his contract was trading at 22%. He has bled off roughly 16% of his position value in a very short window. And the source points to a really specific catalyst for this. It was a YouGov poll showing his support as the ideal 2028 GOP nominee had dropped 5 points since January.
Ah, okay.
And then Newsweek began reporting his chances had hit an all-time low amid, broader headwinds for the current administration.
But there's a detail in the May data that completely subverts traditional political logic, right?
Oh, the endorsement, yeah.
Right. In May 2026, Donald Trump publicly endorsed a Vance Rubio dream team at a White House event. I mean, in conventional politics, a presidential endorsement is the golden ticket.
You'd expect the price to just skyrocket.
Exactly. Instead, the market sold the news. The price actually dropped.
And when an explicit endorsement from a sitting or former president fails to prop up a candidate's price, it sends a blaring signal across the trading desks.
What are they seeing that the pundits aren't?
Prediction markets don't just factor in who can win a primary, they factor in general election viability and donor infrastructure. If traders see structural weakness in a campaign, like maybe the internal polling is soft, or the donor money isn't following the endorsement, they will sell right into that hype. The political narrative said Vance was locked in, but the market's capital allocation said they just didn't believe it.
So Vance is enduring this slow, painful bleed, which gives traders plenty of time to short him.
Right.
But let's contrast that with the explosive, absolute chaos on the insurgent side. Tucker Carlson's movement on the board is just staggering.
It's wild.
On June 2nd, his contract surged from 5% to nearly 10% in a single hour.
1 hour.
Yeah. The Washington Times reported this was due to massive media attention surrounding his critical stance on Trump and an operation in Iran. A 100% gain in contract value in 60 minutes.
I remember the leverage. At 5x leverage, a trader literally just quintupled their money during a lunch break.
But wait, let's look at the reality of the situation. Carlson hasn't even announced a campaign. There's no exploratory committee, no staff in Iowa. If he just stays on television and never files the paperwork, that contract eventually resolves to zero.
Exactly.
Buying into that with leverage seems like nothing more than high-stakes gambling on a media cycle.
It is an immense risk, but the
Yeah.
analysis doesn't suggest just blindly buying into the hype. It details a strategy called a pairs trade to kind of manage the absurdity of the attention economy.
Okay, how did that work?
Look at how the board is priced. Carlson is sitting at 10%. Ron DeSantis, who is an established politician with existing donor networks and a track record of running in 2024, is trading at just 4%.
Wow.
So the market is currently valuing a media figure with zero infrastructure at more than double the probability of a sitting governor.
So if you think the market is overvaluing the media noise, you don't just ignore it. You execute a trade that pits reality against the hype.
Exactly.
You buy no shares on Tucker Carlson. You're essentially shorting him, betting his price will collapse as the reality of not running sets in. And simultaneously, you take a long position on Ron DeSantis. You bet that the historical rules of politics, like ground games and fundraising, will eventually reassert themselves and bring DeSantis's price up.
Right. You are trading the spread between the two. You aren't relying on one specific outcome. You are betting that the gap between media frenzy and political reality will eventually normalize.
Okay, so the Republican side shows us how media narratives and polling drops dictate leverage.
Yeah.
But the Democratic side introduces a completely different dynamic. It illustrates how traders hunt for cheap momentum and, crucially, the severe dangers of trying to catch a falling knife.
Oh, the falling knives are so dangerous.
Yeah.
But let's start with the momentum. Gavin Newsom is the clear rising asset on the Democratic side. He holds 16.1% for the general election, but a massive 24 to 25% probability to win the Democratic nomination.
Right.
Newsweek noted his support doubled following some high-profile clashes with the Trump administration. He has upward momentum, which provides a much safer foundation for a leveraged position compared to a fading frontrunner.
But the board is also littered with cautionary tales, right? Like, Kamala Harris faded from 8% down to 5.1%.
Yeah, that was a steep drop.
The catalyst was a DNC autopsy report heavily criticizing her for writing off rural America. She has publicly stated she is thinking about running, but donor enthusiasm is mixed, So she becomes a classic falling knife.
Exactly.
You might look at her historical prominence, think 5.1% is the absolute floor, buy in on margin, and instantly get wiped out with a margin call if she drops to 2%.
And traders looking for value, they tend to avoid the falling knives entirely. Instead, they look for dormant contracts that are highly sensitive to narrative pressure.
Mm-hmm.
The reaction to John Ossoff is a prime example of how disconnected the financial market is from stated political intent. His contract jumped from 7% up to roughly 10%.
And the reason for that jump was literally just a single opinion piece in the New York Times published on June 8th, calling him an ideal candidate.
Just an op-ed.
Yeah. What makes this so fascinating is that Ossoff himself has explicitly gone on record stating he has zero interest in running.
Right.
Yet a financial market with real capital on the line assigned more weight to one newspaper column than to the actual words of the politician.
Well, traders know that stated intent is notoriously unreliable in politics.
Fair point.
They aren't trading on Ossoff's current desires. They are trading on the media's ability to manufacture a draft movement. If enough op-eds are written and enough donors start making phone calls, that momentum can theoretically force a candidate's hand.
So the market often discounts the press release and prices in the underlying pressure.
Exactly.
Taking that a step further, the source highlights a massive untapped opportunity in the deeply discounted progressive wing.
Oh, this is a great example.
Alexandria Ocasio-Cortez is trading at just 5.6%.
Yeah.
However, an Atlas Intel poll showed her completely dominating the progressive primary field at 26%.
Yeah.
And Axios reported in May that she was making subtle moves toward a potential run.
Right, and when you apply the math of leverage to a 5.6-cent contract with that kind of underlying polling strength, the potential returns are staggering.
Run the numbers for us.
Well, if she formally enters the race and solidifies that progressive block, moving her contract to just 15%, a trader utilizing 5x leverage sees a return on capital exceeding 800%.
800%, wow.
Yeah, you deploy a very small amount of absolute capital for a massive outsized return.
Which introduces the overarching strategy the trading analysis ultimately recommends.
Yeah.
You don't take your entire account and dump it into Gavin Newsom or J.D. Vance.
No, definitely not.
You treat these low-probability candidates like the penny stocks of the political world. You basically build a venture capital portfolio.
The venture capital model relies on extreme asymmetry. I mean, a venture firm might fund 50 startups fully expecting 45 of them to just go bankrupt.
Right.
The model works because the 5 that survive will yield returns so massive they pay for all the failures and still generate a massive profit. You apply that exact same logic to these political contracts.
Okay, give us an example.
Look at Josh Shapiro. He is priced at an incredibly low 2.9%.
Basically, the market has practically priced him for dead.
Exactly.
Yet he is sitting on a 60% approval rating in Pennsylvania, which is arguably the most critical swing state in the country. A recent Quinnipiac poll even showed him beating Vance 53-43 in a hypothetical matchup there.
And earlier in the year, Shapiro was polling at 10% nationally.
So the risk-reward ratio is entirely skewed in the trader's favor.
Completely. Buying in at 2.9 cents means your maximum absolute risk is pennies. If Shapiro simply regains his previous 10% polling position, he doesn't even have to win the nomination, just experience a polling mean reversion. A 5x leveraged bet on that tiny movement becomes a 12x return on the capital you deployed.
And Pete Buttigieg fits the exact same profile, right?
Yep.
He is sitting at just 2.3%. He led a February poll in New Hampshire at 20% and literally told an interviewer to save me a seat for the next cycle.
I mean, that is a glaring signal of intent.
Yeah, yet he is priced even lower than Shapiro.
So a disciplined trader builds a basket of these scenarios. You allocate capital to your progressive breakout ticket with AOC, your moderate swing state ticket with Shapiro, and your generational shift ticket with Buttigieg.
Okay.
You cap your downside by buying them for pennies, while keeping a 10x or 20x upside open if just one of those narratives catches fire in the media.
And you can also hedge that volatile basket with slightly more established players who still have room to run, right?
Yeah.
Like Marco Rubio sitting at 15.6%.
Right.
He saw a massive surge in the CPAC straw poll, jumping from 3% to 35%. And AOL recently reported that GOP donors are quietly building infrastructure around him, sort of positioning him as the establishment alternative if Vance continues to fade.
Yeah.
Even at 15.6%, applying 3x leverage to a climb to 25% yields a 180% return.
But, you know, understanding who to put in this portfolio is really only half the equation.
What's the other half?
The most critical element detailed in the source material is the timeline. These traders are not buying these contracts with the intention of holding them until November 2028.
Oh, right.
They view the election cycle as a sequence of highly predictable volatility windows.
So they are trading the calendar.
Exactly.
The first massive repricing event is coming up fast, which is November 3, 2026, the midterm elections. For Democrats to change the balance of power, they need a net gain of 4 Senate seats. And states like Georgia and Michigan are just hanging by a thread as toss-ups.
And what's fascinating here is that the outcome of those specific Senate races will instantly reshape the 2028 presidential odds. If the Democrats pull off a wave election and secure those seats, candidates who spent the fall campaigning heavily in those states, like Newsom or Buttigieg, will see their odds spike overnight as they claim credit for the momentum.
And if Republicans hold the line.
Then it validates the current administration and could instantly halt J.D. Vance's declining numbers. The entire polymarket board will fundamentally reprice on the morning of November 4th.
And then we roll right into 2027. Quarter 1 is when the DNC finalizes the primary calendar. The order of the states is everything.
Oh, yeah.
If the committee prioritizes diverse electorates over the traditional Iowa and New Hampshire starts, candidates like Shapiro from Pennsylvania or Ossoff from Georgia suddenly inherit a massive structural advantage, and their prices will jump to reflect that new reality.
Following the calendar finalization, we enter summer 2027, which marks the start of the primary debates. And for anyone trading on leverage, the debate schedule is the ultimate catalyst.
Because it's live television.
Right. It's unscripted television where a breakout performance can double a candidate's odds in a matter of hours, and a single freeze-up can result in a margin call.
So the strategy here is really all about timing the uncertainty. Sophisticated traders don't wait for the debate to happen or the midterm votes to be counted.
No, that's too late.
They enter their positions in the fog of uncertainty well before the prediction markets converge with the actual polling aggregates.
They buy when the uncertainty is at its absolute peak, because that is when the contracts are cheapest and the potential leverage swings are the most dramatic. Once the event occurs and the market is forced to reprice based on the new reality, they exit the position, take their profits, and just wait for the next date on the volatility calendar.
You know, viewing the political cycle through this lens completely changes how you interact with the news.
It really does.
A presidential debate isn't just a civic forum to discuss policy anymore. It is effectively an earnings call. It is a televised event engineered to inject volatility into a financial market.
It strips away the spin of the talking heads telling you who supposedly won or lost. The deployed capital doesn't care about the spin. It only cares about the mathematical probability of the outcome.
Bringing all of this together, the 2028 prediction market as it stands in June 2026 is a truly unique beast. There is no dominant leader commanding the board. There is massive, wild volatility driven by fleeting news cycles and opinion columns. And the availability of leverage allows traders to amplify these micro shifts in momentum into massive financial returns while utilizing capital highly efficiently.
We are essentially watching a hyper-efficient financial mechanism attempt to price a wildly inefficient and emotional political system.
Right.
And even if you never log on to Predmart, and even if you never place a single trade, understanding how these leveraged traders view the board gives you an incredibly powerful tool.
Exactly.
It gives you an unvarnished, data-driven view of who actually holds momentum, cutting straight through the wishful thinking of traditional political media.
It definitely changes the way you read a headline. But it also leaves me with the thought that I haven't been able to shake since reading through this source material. Well, we started out by talking about how this market reacts to news, polls, and op-eds. But if prediction markets and leverage make political volatility this incredibly profitable, how long until the financial traders stop just reacting to the news and start trying to manufacture the political catalysts themselves just to move the needle?
Oh, wow. Yeah.
I mean, if millions of dollars can be made on a single newspaper column about John Ossoff, the financial incentive to ensure that column gets written becomes very, very strong.
That is a wild thought.
Something to keep in mind the next time you see a surprising narrative suddenly dominating your feed. We'll leave you to mull that over. Until next time.